So we are just looking at this last topic, and this is called revenue, right? So this accounting standard is known as IFRS 15. We have studied IS 10 above, which was events after the reporting period, right? This one is revenue from contracts with customers. Okay. Now what happens is that first let me give you a small introduction of this. So what happens is that this is not like the normal revenue, right? This standard is specifically designed for that kind of revenue which occurs, over a period of time, right? Like let's say if there is a contract of constructing a building, let's say like 10 or 20 floors building, right? And that contract lasts for like 6 7 years or 8 years or even 10 years, right? So revenue is earned, right, in very small amounts in that case, because after each and every performance obligation is satisfied, after that what happens is that at very small point in time the revenue is recognized in very small chunks, right? So this standard is designed specifically for that kind of revenue. Similarly, if like let's say we purchase a 1 year subscription for a TV service, let's say, right, a TV channel service, or let's say like movie watching, everything like that, right? So that subscription will also be accounted for under IFRS 15 for those people, the people who are receiving the money. Because let's say we are using it for 12 months, right? Let's say they are recognizing revenue for each week or each month separately. It depends upon the policy. Okay. Now, recognition of revenue is vital to the fair presentation of financial statements. For many business entities, the revenue figure is the largest financial value included in the financial statements. Yes, that's correct, no doubt. With most transaction, it is relatively easy to determine when and how much revenue has been earned. However, for some entities, this is not always easy to determine or quantify, and some entities have adopt a range of accounting treatments in an effort to comply with the reporting requirements. For example, if an entity supplies a bundle of combination of goods, right, or services to a customer, it can be more difficult to identify when or how much revenue has been earned, right? So if it's like a combination, let's say if you're buying a new machine or a new laptop or a new computer, they're giving you, let's say, a mouse and a keyboard and a speaker free with that as well. So for that kind of company, it's very challenging to record the revenue, right? So that is what we will be studying in this part. Now, revenue should be stated in financial statements, excluding sales tax and also excluding amounts collected on behalf of others. This we have already looked in the start. When we were looking at sales tax, I told you that sales and purchase figure is always excluding the sales tax. It just contains the product price, right? Now, for example, if travel agent received the holiday booking from a client for an all-inclusive price of $1,000, so the travel agent is charging the all-inclusive price of how much? $1,000, on which they are entitled to a 10% commission. So that means out of $1,000, the agent will keep how much money? Only $100. That is 10%, right? So travel agent will recognize revenue of $100 with the balance of 900 accounted for as a liability due to the holiday company. Obviously, because holiday company will, come to the agent, let's say after 1 week or after 1 month, and collect all the payments that are liable to those holiday company for all the customers that the agent has dealt with, right? So this agent just needs to recognize a revenue of 100 because he has done his thing, right? Now the other 900 belongs not to him but to the holiday company. The holiday company will recognize a revenue of 1000. Yes, that's correct as well, but less the expense of 100 commission to the travel agent. So it depends on person to person how they are recording the revenue and the liabilities. Now, here the IFRS 15 is starting, right? And first of all, we are discussing revenue is defined as income arising in the course of an entity's ordinary activities. Obviously, revenue incurs every day. In large company, it occurs every minute, every second, right? Now, there are 5 steps to recognize the revenue. In this case, it is very simple, very interesting, very easy to understand. The first step, as you can see over here, is identify the contract. First of all, before doing anything else, we have to identify what actually we are selling, right? Now, second thing, identify the separate performance obligations within a contract. So let's say if I am selling you the F3 course, right, and I am demanding you the price, what am I giving you? What performance obligations I'm satisfying? I have to do the whole book. I have to complete the whole syllabus, right? I have to do all the exam kit questions. right? I have to explain you all the concepts. I have to take the purchased marks from you once you're done with all the syllabus. It's like a test, right? So these are the separate performance obligations that I'm satisfying. Okay. Now the third one is determine the transaction price. Now after that, obviously we'll have to see what is the total price that I'm charging, right? The seller, what is it totally charging the price, right? Now after that, we have to allocate this transaction price that we found out in step number 3 to the separate performance obligation that I'm fulfilling in the contract. Let's say you're buying a new product, and let's say you're buying a new laptop, right? Now you buy a laptop as well, and let's say the charger is included in that. Let's say you plan to buy an expensive headphone with that as well, right? So headphones are separate. Let's say you plan to buy speakers with that as well, right? Let's say you plan to buy some kind of, a tablet and a pen to write on the screen as well, right? So that means these are the different kind of performance obligations that the company is selling to you and you are buying. So we need to allocate the transaction price to all those separate performance obligations, right? The easier word to understand would be like, let me give you an example. So you are, let's say, buying a laptop. This is the laptop, right? And with this, the company says that if you buy this laptop, we will give you 3 years warranty, let's say. So anything, any issue which occurs in 3 years, we will fix it for free, right? And let's say company is also giving you an expensive keyboard, which was normally for, let's say, $100, right? And now it's giving to you for free because it's part of the promotion, right? Let's say it's giving you the mouse as well, right? And it was normally for $20, but now it's giving you for free, right? So you see that now the company which is selling the laptop, it's satisfying 4 separate performance obligations. The first obligation is selling the laptop itself. Second obligation is 3 years warranty. Fourth obligation is keyboard, sorry, the third one. And fourth one is the mouse, right? All of these things are combined into the package, right? And you just have to pay one price.
Yes.
That one price, it's their accountant's responsibility to allocate it evenly. Okay. Now once that's allocated to all of these 4 products, the last step is to recognize revenue as performance obligation is satisfied. Let's say their accountant recognizes the revenue for laptop because that has been sold to you. Now let's say, what about this 3 years warranty? So after every year passes, after every year, it's 3 years warranty, right? So in the end of 2022, it will recognize 1 year revenue because 1 year has been satisfied. After end of 2 years, it will recognize another year's revenue. So this 3 years warranty will be split under 3 years. This keyboard will be recognized straight away because it has been sold to you, right? This mouse will also be recognized straight away. So it depends that after every performance obligation is satisfied, each of the revenue is recognized in this case, right? So it's that simple to understand over here. Only 5 steps are involved. Now let's take a look at one example and let's shortly discuss the brief explanations for this as well, right? Now illustration, let's see this one. On 1st December 2011, a WAD company received an order from a customer for the purchase of a computer. Now you see this is a whole package, right? So there is a computer in this package plus 12 months of technical support as well, right? So WAD company delivered the computer there and then, transferred the control of computer on 1st December 2011. That means the same day. The same day that the customer placed order, the laptop was delivered on that same day. The customer paid a total of how much? $420. And this was the price for that, of which comprised $300 for the computer and 120 for the technical support. So this is what the accountant did. It allocated it between the products, right? WAD company has an accounting year end of 31st March 2022. Now, according to this example, let's work out the 5 steps and let's discuss each and every one of them. So step number 1, as you remember, this was identify the contract, right? In identifying, what do we have to do? That WAD company has to supply its customer for provision of goods, which was computer, and services as well, which was 12 months of technical support. Two things are involved over here, right? Now identify the separate performance obligation. The first promise obligation is basically promise, right? First promise is that WADCO agreed to supply the computer. That's correct. And second promise is WADCO agreed for the 12 months technical support,
Yeah.
right? So this is the step 2. We have identified separate performance obligations. Now we need to determine the transaction price. The transaction price is written in the question. It was $420, right? This step is important for revenue recognition, as if credit customers are offered early settlement discount, the amount of revenue receivable will be variable, depending on that credit customers take the discount or not, right? So it's again that discount knowledge that we have already studied, but this will be very rare. The transaction price will be given to you. Now, step 4 was to allocate this transaction price into the performance obligations, right? So, based upon standalone prices, $300 should be allocated to sale of computer, and 120 should be allocated to the supply of technical support. This was also written in the question. We just have to follow the steps. So, step 5 was recognize revenue as performance obligation is satisfied, right? So, you can see that how the revenue is being recorded. The performance obligation to sell a computer is satisfied at a point in time because the computer was delivered the same day. It's written in the question as well, right? Control of the computer was transferred to the customer on 1st December. So revenue was recognized only $300, right? Not the whole 420, only the $300. Now the performance obligation to supply technical support is recognized over a period of time, right? Because there was 12 months technical support, right? 12 months warranty, we can say. It was starting on
Yeah.
1st December because this was the first day. In the year ended 31st March 2012, because 31st March 2012 is a year end. How many months are there? December, January, February, March. Only 4 months. So at the year end, only 4 months will have been passed. So what we'll do is at the year end, we'll record 120 into 4 by 12 only, which is $40, right? And the remaining items, how will they be accounted for? Customer paid 420 immediately, right? Total recognized as revenue is 300 plus 40. 300 for this computer and $40 here for this technical support, because only 4 months
Yeah.
have passed. So only 340 will be recognized as revenue. And what is the difference between them? $80. $80 will be recorded as a current liability, because this is the revenue that actually right now does not belong to us. It will belong to us during the next 12 or 18 months that are coming, because still some months are remaining, right? 4 months have passed, 18 months are remaining. Sorry, 4 months have passed, 8 months are remaining, right? That makes it whole 12 months. So this 80 will be recorded when the 8 months have passed.
Right.
Okay. So this is the steps we have to follow. This is your homework. You can read it at home. This is further detail, right? This is very simple. Again, the same things are being discussed, right? And finally, our chapter for IFRS 15 has ended as well. Let's read this as well. Disclosure requirements. So again, what is the disclosure requirements? What items do we need to tell the shareholder? First of all, accounting policy for revenue recognition should be disclosed. Like what policy did we use? Did we actually use IFRS 15? How did we account for it? Then significant judgments made to apply 5-step approach, right? So how did we, uh, accounted for the amounts that are used in the 5-step? We also have to tell that. And total amount of revenue recognized broken down into significant categories should be disclosed as well. These are the disclosure requirements. Okay, got it? Clear? So this